Hey everyone, and welcome back to Everything About Accounting. We've covered revenue and expenses. Now, let's talk about a specific type of asset, accounts receivable. In simple terms, accounts receivable, often abbreviated as A/R, is the money a company is owed by its customers for goods or services that have been delivered but not yet paid for. It's essentially credit that a company extends to its customers. Think back to our lemonade stand. If you let a friend take a cup of lemonade now and promise to pay you later, that unpaid amount is your accounts receivable. Accounts receivable is considered a current asset on the balance sheet because it's expected to be converted into cash within a year. It represents short-term credit extended to customers. Managing accounts receivable effectively is crucial. Companies want to collect this money as quickly as possible to maintain healthy cash flow. Companies often have policies in place to encourage timely payments, such as offering discounts for early payment or charging late fees. There's always a risk that some customers won't pay their bills. This is known as bad debt. Companies need to account for this potential loss. So, to summarize, accounts receivable is the money owed to a company by its customers for goods or services that have been delivered but not yet paid one for. It's a current asset and needs to be managed carefully. There you have it, accounts receivable explained in under 90 seconds. Are you finding these term explanations helpful? Let me know in the comments. And don't forget to subscribe for more quick and easy accounting lessons. What should we explore next? Thanks for watching, and I'll see you in the next video.